Welcome back to Derivatives and Risk Education. In this video, we'll look at how to pitch outright and curve trades in rates. We'll start by explaining the instruments, the catalysts, and the risks. Then we'll walk through two worked examples, one using bond futures for an outright view and one using swaps for a curve trade. First, let's look at the catalysts. What moves rates? When you pitch a rates trade, you need to explain why the yields will move. Here are some of the main drivers which you can use as catalysts in your pitch. Central bank policy, from the Fed, ECB, Bank of England decisions and guidance. Inflation data like CPI, growth data like GDP and employment numbers, also PMIs. And for bonds, there's also supply and demand, like treasury issuance, quantitative easing, QE, and also QT programs. And finally, risk sentiment, geopolitical shocks, flight to safety, liquidity squeezes. What about the risks? What could go wrong? Every pitch needs risks. For rates trades, risks you could include are inflation surprises. For example, if inflation stays sticky, yields won't fall. Policy error. Central banks may stay hawkish longer than expected. And fiscal supply. Heavy issuance can push yields higher. And there's also funding risk. Repo markets might tighten, raising the cost of holding bonds. And finally, liquidity risk. Stressed markets could widen bid-ask spreads. Now let's look at some of the instruments you could use for a trade pitch in rates. Government bonds are debt issued by sovereigns. They include US Treasuries, German bonds, or UK gilts. If you buy a bond outright, you earn the coupon and you're exposed to changes in yields. But you usually finance bonds in the repo market, and that funding cost affects your return. If repo is cheap, carry is positive, and if repo is expensive, carry can be negative. Liquidity is best in benchmark maturities, like 2-year, 10-year, or 30-year bonds. Instead of buying the bond itself, you can use futures. Treasury futures give you clean exposure to yields without worrying about the repo funding. They're standardized, highly liquid, and leveraged. Trade-off is basis risk. Futures are tied to the cheapest to deliver bond, which may not move exactly like the cash bond. Then interest rate swaps, IRS. The most common type of interest rate swap is where one side pays fixed and receives floating. For an outright view, if you think rates will fall, you receive fixed. Swaps are powerful because they don't involve repo funding. You can choose any tenor with precision, and they're liquid and standardized. Professionals often prefer swaps for outright and curve trades. Now we should briefly talk about DV01, dollar value of a basis point. Different instruments have different sensitivities to interest rate movements. DV01 is the standard way to measure interest rate risk. It tells you how much your position gains or loses if yields move by 1 basis point, which is 0.01%. Example, if your long 10-year bond position has a DV01 of $50,000, then a 1 basis point fall in yields means a $50,000 profit. DV01 lets you compare risk consistently across bonds, futures, and swaps. And finally, there are curve trades. Beyond the outright views, you can trade the shape of the yield curve. A steepener means short-term yields fall more than long-term yields, so the yield curve becomes steeper or less inverted. A flattener means long-term yields fall relative to short-term. Swaps are the professional tool here because they let you pick exact tenors and balance DV01 precisely. Bonds are clunky, maturities are discrete, the liquidity varies, and it's hard to size the risk cleanly. Now, let's look at two detailed trade pitch examples for rates. First of all, an outright view using bond futures. Over the next quarter, I would go long 10-year US Treasuries using Treasury futures. Growth momentum is slowing, and the Fed has signaled it is closer to easing policy. That combination could put downward pressure on yields. I prefer futures rather than cash bonds because they give me clean duration exposure without repo funding costs. Liquidity in Treasury futures is excellent and they're standardized, so it's easy to size the position using DVO1. So the structure is simple: long Treasury futures targeting a move in 10-year yields from around 4.5% down to 4%. I'll set a stop if yields break above 4.75%. That gives me a defined risk-reward profile and shows discipline. As a second example, we'll look at a curve trade using swaps. I would put on a 2-year versus 10-year steepener in US dollar swaps. Right now, the curve is unusually inverted, with 2-year yields well above 10-year yields. Historically, that doesn't persist once inflation cools and the Fed starts cutting. The catalyst is that inflation prints are trending lower, and the market expects the Fed to pivot. In that environment, short end yields should fall faster than the long end, leading to a steeper curve. I would structure the trade by receiving fixed in 2-year swaps and paying fixed in 10-year swaps. Sized DVO1 neutral, so the risk is balanced between the two legs. My target would be a 25 basis point steepening of the curve, with a reassessment after the next CPI release and Fed meeting. How swaps give precision, allow risk balancing, and make curve trades cleaner than bonds. So, when you prepare a rates pitch, make sure you understand the instruments first: bonds, futures, and swaps, and deliver a clear, professional example, whether it's an outright view via bond futures or a curve trade via swaps. The key is to sound structured, disciplined, and realistic. If you found this video helpful, make sure to like and subscribe, share with anyone else who you think could benefit. Thanks for watching.